In this video we will talk about inventory.
What is inventory?
The term inventory refers to the raw materials used in production as well as the goods produced that are available for sale. A company's inventory represents one of the most important assets it has. Because the turnover of inventory represents one of the primary sources of revenue generation and subsequent earnings for the company's shareholders. There are three types of inventory, including raw materials, work in progress, and finished goods. It is categorized as a current asset on a company's balance sheet. Inventory is a very important asset for any company. It is defined as the array of goods used in production or finished goods held by a company during its normal course of business.
A little about types of inventory?
Remember that inventory is generally categorized as raw materials, work in progress, and finished goods. The IRS also classifies merchandise and supplies as additional categories of inventory. 1. Raw materials are unprocessed materials used to produce a good. 2. Work in progress inventory is the partially finished goods waiting for completion and resale. Work in progress inventory is also known as inventory on the production floor. A half-assembled airliner or a partially completed yacht is considered to be a work in process inventory. 3. Finished goods are products that go through the production process and are completed and ready for sale. Retailers typically refer to this inventory as merchandise. Common examples of merchandise include electronics, clothes, and cars held by retailers. Now let's discuss a little about inventory management. Possessing a high amount of inventory for a long time is usually not a good idea for a business. That's because of the challenges it presents, including storage costs, spoilage costs, and the threat of obsolescence. Possessing too little inventory also has its disadvantages. For instance, a company runs the risk of market share erosion and losing profit from potential sales. Inventory management forecasts and strategies, such as a just-in-time inventory system, with backflush costing, can help companies minimize inventory costs. Because goods are created or received only when needed, it's always a good idea for companies to invest in a good inventory management system. This is especially true for larger businesses with multiple sales channels and storage facilities. These systems are able to identify waste, low turnover, and fraud, or robbery. Bottom line, inventory provides businesses with materials to keep their operations going. This includes any raw materials needed in the production of goods and services, as well as any finished goods that companies sell to consumers on the market. Managing inventory and determining the turnover rate can help companies determine just how successful they are and where they can pick up the slack when the profits begin to dry up. Let's summarize our today's topic. 1. Inventory is the raw materials used to produce goods as well as the goods that are available for sale. 2. It is classified as a current asset on a company's balance sheet. 3. The three types of inventory include raw materials, work in progress, and finished goods. 4. Inventory is valued in one of three ways, including the first in, first out method, the last in, first out method, and the weighted average method. 5. Inventory management allows businesses to minimize inventory costs as they create or receive goods on an as-needed basis. In next video we will discuss about ways of valuation of inventory.